What is happening to the world right now, and what on earth is the stock market doing? Hey guys, it's Dan here and welcome to another episode. In this video I'm going to try and break down with some facts and numbers the current situation of the economy and why we need to be a bit more careful in the stock market at the moment. If you want to learn more about investing in the stock market and become more financially literate, consider subscribing to my channel and you'll get notified when a new video comes out. Also, don't forget to give a thumbs up if you enjoy this video as well. So if you've been following the stock market closely, you should know by now that the stock market doesn't necessarily reflect what is happening in the world right now. In simple terms, the stock market moves according to the laws of demand and supply. But it's very forward-looking and basically has its foundations built on expectations about economic prosperity and the growth of corporations. The easiest example to illustrate this is when companies release their earnings performance. Before the actual release, there are already expectations of the company's performance based on the forward guidance from last period's release, analyst projections using sophisticated models, financial statements, performance from industry peers, etc., etc. And these expectations form what's called consensus estimates. Upon the release, the stock prices will move in relation to how well the company has performed against those estimates, but also on what the outlook is on the upcoming period. So sometimes you may find that the company has beaten estimates, but the stock price has still dropped. And that could be because the outlook ahead isn't as positive. Sometimes no guidance on the outlook of future periods is provided because there's simply too much uncertainty ahead, which is what some companies have been doing over the past few months. Using the same logic, we can kind of explain why stock prices are mostly about expectations and often removed from reality. The first COVID-19 case in the US was on the 21st of January, well before the US reached its 50,000th case. The stock market had already bottomed. Before the cases exponentially increased, the market was already expecting a disastrous effect on the economy from this pandemic. Expectations were built on data such as projected confirmed cases, the preparedness of response, what was happening in other countries, and the probability of producing a vaccine, etc. You would have noticed that with any surprise to those expectations, the market would swing with substantial volatility. At the time of recording this video, the Dow had just slid 1,800 points, as people fear that a second wave could happen as cases spiked again in a few states. So this was a little surprise to what people were expecting, and that is fine because that's how the stock market works. Long before the pandemic occurred, many analysts were already predicting a market crash in 2020, and this prediction wasn't based on the probability of a pandemic. In fact, there were many indicators that pointed to the economy facing headwinds in the near future, just not a pandemic. There were the trade conflicts between China and the US, concerns about high valuations of the stock market, and the inversion of the US Treasury yield curve, which was an indication of risk in the bond market. And historically, the yield curve has been used to predict low growth and recessions, and has been a pretty successful indicator for impending recessions, hence the crash prediction. So it should be clear by now that the most recent market crash wasn't a direct result of the factors we just briefly discussed. But was the magnitude of the crash worsened by those factors? Maybe. Though it's just too difficult to gauge exactly how much the stock market should have fallen solely on the basis of the pandemic, with other factors constant. But more importantly, is the stock market recovering from its lows too quickly? And is the reality overshadowed by our optimism? Have a look at the GDP predictions for 2020. This is a chart prepared by the OECD. As you can see, the projections aren't very optimistic at all. According to the OECD, the world is projected to lose around 6% of the GDP. The OECD, however, has also projected a double hit scenario, which is the loss if a second wave were to happen. Let's then look at predictions by the IMF. World output, negative growth rate of 3%, much more optimistic than the OECD. Interestingly though, China and India are still projected to have a positive growth rate this year. Obviously it all depends on how each country has responded to the pandemic, but you get the theme though, pretty ugly numbers across the board. No one really knows how this will all turn out. Bear in mind that at a global level we aren't really seeing a slowdown in the number of cases at all. Although we've seen improvements in most of the developed countries, there are still plenty of countries lagging behind in recovery. This is a chart showing how the major economies are recovering. Mobility is a measure of the extent of lockdown, so low mobility means there's still lots of restrictions throughout the area. So the countries on the left side of the chart are the worrisome ones, and especially ones with high mobility but low recovery. Now, at an industry level, we all know which industry was hit the worst: travel and tourism. According to the World Travel and Tourism Council, the number of job losses in this industry is projected to be north of 100 million, and an associated GDP loss of 2.7 trillion USD. Those are staggering numbers. Again, these are only projected numbers, but by the hour, the minute, maybe more jobs are getting cut. Companies are borrowing more money, and confirmed cases are still rising. This is an infographic showing countries most reliant on travel and tourism. Think about how many of these countries have had their international routes cancelled or suspended, and how many of those will never resume, as it's just no longer economical to fly to those destinations again. From the small country's perspective, there's a big possibility that they will not recover to pre-pandemic levels until who knows when. And the same thing goes for the airlines. Consider the airlines having to implement social distancing inside the aircrafts themselves, and some have already started to. Most of us know the airline's revenue is also based on the simple equation quantity times price, quantity being the number of seats and price being the ticket price. In the airline industry, there's a metric called the load factor, which measures the utilization percentage of available seating capacity. So with utilization down due to social distancing, you have less seats that you can actually sell. Then you're only really left with the price variable to keep your revenue somewhat reasonable. If you increase the price, there's a good chance that demand for flights will start going down. People will begin to reassess their holiday plans, etc. And that isn't something you want to see when you're trying to recover. Though there have been creative ideas of implementing social distancing, but this would take some time to execute. One idea is to have a divider on all seats, which provides physical separation from the head to the shoulders. This should be fairly easy to install. Another is to have rear-facing middle seats with barriers surrounding the seats. Pretty creative idea too, but will likely take longer time to implement compared to the first concept. The airlines can attempt to adjust their costs, but not a lot that you can do there. You can't really swap out bigger planes for smaller ones because then social distancing will be compromised. And do you really want to take that risk because you've also got your reputation on the line? So you may end up flying those original airplanes to those destinations again, but this time with a lot less seats occupied. Yes, you've cut jobs and your labor costs are down, and the oil prices aren't as high as before, but we all know how cyclical oil prices can be. While a lot of the risks have already been priced into the stock market, I think there's still plenty of uncertainty to be uncovered. The truth is this pandemic is like no other, and there's no benchmark to compare the before and after. Ramifications from the COVID-19 have far exceeded damage done by SARS in 2003 and MERS in 2012, and it's not even done yet. The nature of this crisis is also very different to that of 08 and 09, so trying to make comparisons between the two is like comparing apples to oranges. The one thing Warren Buffett in the recent Berkshire AGM that really resonated with me was when he said that the world has changed for the airlines, and I don't know how it has changed. The fact that Warren Buffett sold all his airline shares drew a lot of criticism, and even more so with the stock market near all-time highs. Lots of articles questioning his rationale behind that decision and whether he's making a mistake. What we need to know is that Warren Buffett is not a speculator. If he sees that a business isn't going to be profitable in the years to come, then he will sell that position. You're probably seeing the stock prices of cruise lines, airlines shooting up from their lows, but where are the numbers to support that? How will these companies continue to operate when there's still no vaccine? And how will these companies be profitable again, given they're so debt-ridden now? It's not about whether we will continue to do what we used to do. Airlines are still going to keep selling flights. People are still going to fly on airplanes because that is the most efficient way to travel between two distant locations. But the biggest change is how we do that. Because COVID-19 has come in and disrupted our lives, and if we don't end up with a vaccine soon, there's a very high chance that we'll need to change the way we live forever. Now, another reason that many people think the stock market has recovered too quickly is due to high valuations of the market. The S&P 500 is up almost 10% compared to a year ago, as if the pandemic never happened. Let's look at the valuation of the market holistically. One of the most popular metrics is the Shiller's PE ratio, which takes the price level of S&P 500 and divides it by the inflation-adjusted earnings of the preceding 10 years. So from first glance, we see that currently the Shiller's PE ratio is at 29.9, which is quite high if we look at the figures in the preceding years. But that should not be looked at in isolation, because over the century a lot has happened. The biggest game changer in the economy today is no doubt technology, and it's kind of obvious. The top companies right now are tech companies. With the S&P 500 being a market cap weighted index, the top tech companies account for quite a large portion of that movement. And it's not illogical that these tech companies have a higher than average PE multiple, as a lot of the valuation is based on high future growth. But with COVID-19, we won't fully understand the extent of the impact on the growth of these tech companies until we start seeing the pandemic subsiding, and that these companies are confident enough to have a view on their future. All in all, the general feel is that the market seems to have gotten ahead of itself, despite all the uncertainty, the conflicts, tensions going on in the world that just seem to be inextinguishable. We can't deny the fact that this world is in a bit of a mess right now, and this is why we need to be more careful. If you're currently invested in the market, it wouldn't be unwise to start thinking about trimming some of those positions that have reached all-time highs, and to start moving to a more cash-oriented portfolio to reduce some downside risk and give yourself the upper hand if the market does go south. The important thing is that you look at the numbers and the facts and don't let your emotions take control. I know it's tempting to buy more into the market right now because you probably see people commenting on what they've bought and how much they've made in a week. You need to assess the situation from your perspective and determine whether the action you're about to take is reasonable given the risk. And sometimes taking no action may be the right thing to do, but the main thing is you're comfortable with your decisions and that they were made based on a thorough thought process. Anyhow, I hope that you guys have enjoyed this video, and if you found it informative, do me a favor and hit the like button so that more people on this platform are able to see it. And if you want to see more of these videos, just subscribe to the channel and you'll get notified of the new ones. Otherwise, have an awesome day and be safe out there.